So, if I am not fundamentally worried about bank failures, as we kind of walk through that exercise and discussion in the prior segment of the program, at the end of the day, over the past 20 years, there's been 565 bank failures. Banks are businesses just like anything else. So, if bank failures don't necessarily trouble me, but at the end of the day, businesses need to be smarter in terms of who they're doing business with. What does trouble me out of all of this? And that's what we'll talk about in this segment of the program. So welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars, including headlines that involve bank failures, Federal Reserve, interest rate increases, and the like. Of course, we're one of the top 25 financial planning podcasts on the World Wide Web as well. So make sure you check us out on your favorite podcast platform or even our YouTube channel. Simply go to our website, nelsonfinancialplanning.com, and you'll see icons there that will allow you to connect directly into our channels on those various platforms if you have any trouble finding us on whatever the platform is that you are on. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries as well that can help you change your life with a successful and cost-effective financial plan. So if I'm not worried about bank failures, what am I worried about? Well, I'm worried about the everybody gets a trophy mentality at the Federal Reserve. Let me say that again. The everybody gets a trophy mentality at the Federal Reserve. Now, for those of you who know me or longtime listeners of the program, you know that I have 3 boys. And when the boys were younger, they're older now, they're all in college, one's about ready to graduate, I was very involved in coaching youth sports. And so one of the things that I observed as I was coaching my kids as young kids and they were going up through the ranks is it just seemed like it used to be when I played youth sports, like the team that won at the end of the season, they were the team that got a trophy. And maybe the team that, kind of got to the championship match and lost got a trophy as well, but it was definitely like a smaller trophy, if you will. And one of the things I observed is that everybody got a trophy of exactly the same size, same look, same feel. It didn't matter whether you had gone through the season undefeated or had lost every game. Everybody gets a trophy. And so over the years, my kids' rooms were filled with trophies. We do sports on a regular basis. And it just, when you think about that, and when I would stand in my kids' room and look, and, when I was a kid, the notion of getting a trophy kind of meant something. And it sort of doesn't. And the problem with that, I think, is that it doesn't reward success and it doesn't give an opportunity for our youth to see that. Because when you get out of the protective confines of your home or your school or whatever the case may be, the reality is people get fired all the time from their jobs because of poor performance. So maybe you want to try and do better so that doesn't happen. Well, along comes the Federal Reserve with its own version of the everybody gets a trophy mentality, because that's exactly what you've seen over the course of the past 2 weeks. The 2 bank failures that happened in both cases, the Federal Reserve almost immediately stepped in and said, that $250,000 FDIC limit, don't worry about it. We got you covered all the way up to whatever cash you had on file with the bank. Regardless of whether you didn't even bother to do your due diligence, regardless of whether you had a risk manager or a chief financial officer that should have been checking that stuff out, it's okay. We got you. This idea was furthered by Treasury Secretary Janet Yellen last week in a speech that she gave to none other than the American Bankers Association conference in Washington. It said, if intervention is necessary, similar actions would be warranted. So what's the problem with all that? What do you think the problem is with all that? It only encourages bad behavior. It doesn't encourage people to do well, to make good decisions, to exercise good business judgment. Because after all, remember, as we've been saying on the program, banks are businesses too. And at the end of the day, if you know that the old Federal Reserve is going to come in and ride to the rescue and you got nothing to worry about, what do you think a bank's going to do? Take a little bit more risk, try and generate a little bit more profit. And at the end of the day, what do you wind up with? Well, you wind up with more bank failures. Sort of a return to the 1980s when, on average, you had a bank fail in this country once every 3 days. Is that really the climate or the environment that we want to produce? Well, with everybody gets a trophy mentality that the Federal Reserve is exhibiting, it's exactly what you're going to have. Now, here's the other part. Here's where it really comes home. Because at the end of the day, if you don't think that you and I and the rest of the American consumer isn't going to foot that bill, well, there's plenty of bridges in Brooklyn. The reality is that while you may not see a line item on your tax return where you have to pay part of your taxes to cover the banks, you're going to see it indirectly in the form of a variety of costs. This is the thing that always amazes me is that I don't think the folks in government really understand that, like, when you tell a business, oh, you can't do that. You can't impose that fee, or you can't push that cost onto consumer. That's fine. There's a million other ways to push costs onto consumers, right? I mean, it doesn't matter whether you change the size of the packaging and you can't get a 5-pound bag of sugar anymore. It's 3 pounds. Okay. Yeah, but we didn't raise the price. Come on. I mean, at the end of the day, we're not so silly as consumers, as Americans, to think that indirectly we won't wind up ultimately footing the bill. So where does that leave you? Well, I think there's a couple of questions from an investment perspective in this landscape that are important to know and to realize. First of all, know what you own. Same thing as know where you're putting your money, which bank you're putting your money in. It's important to know what you own, particularly from an investment perspective. And also know from an investment perspective that what you own is fully accessible at any point in time, meaning that there's full liquidity, full access. So at the end of the day, what does that mean to know what you own? Well, we think it's important that investors have an understanding of exactly what they own down to the detail. Not just, oh, I own a bunch of funds, or oh, I own a bunch of stocks, but really, how does that all shake out in terms of what that picture looks like? Beyond, I've got X% in stocks, Y% in bonds, Z% in cash, what types of companies do I own? Are they small? Are they mid-size? Are they large? What sectors are the companies that I own? What sectors are they in? On the bond side, you can ask the same question. What's the maturity look like of those bonds? What's the credit quality of those bonds look like? We think that's important information to help you as an investor understand what it is that you own. So first and foremost, know what you own. Pretty important stuff when it comes right down to it. At the end of the day, you should be seeing some familiar sort of names in your portfolio, typical types of companies that would have over $1 billion net in sales. So big companies that you would expect to see. And then the other part, to be fully accessible at any point in time, that's really almost a two-part conversation. First of all, you, if you will, to be fully accessible at any point in time. That's kind of important because you don't want to have to wait to the end of the quarter or the end of the year, or whenever somebody lets you actually take money out of the investment that you've made to actually get access to your money, but also on the investment side as well. So it's so important to have that active management to be able to say, okay, we're going to ultimately shift around the positions that you own inside of a particular fund or inside of a particular portfolio, because at the end of the day, if you're just kind of owning purely an index type of an approach, then those holdings aren't going to change. Those holdings are all going to stay exactly the same, and you're not going to get any kind of level of active management. So at the end of the day, those are really kind of the two questions from an investment perspective. Know what you own and know what the accessibility and flexibility is on it that will help you kind of navigate the current environment. When we come back, we're going to talk about ESG investing and Biden's first veto. Coming up next here on the program, Dollars and Cents with Joel Garris of Nelson Financial Planning.